Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, May 5th, 2020. We'll take a quick look at the equity markets here and then touch on some of the existing trade ideas and a few new trade ideas that I want to throw out there. Start out with the index futures, and before I even get in, let me just tell you where kind of my thoughts are. We've had some sell signals recently highlighted on breakdowns on the 60-minute charts of the indexes, some trend lines, and then some others, some of the key sectors as well. But as I posted yesterday, we hit some key support levels on a lot of indexes and the major, a lot of these sectors, the market leading sectors, and some of the indexes hit support as well. So where we're at is the market's been resilient, holding up relatively well despite the recent sell signals, but still stair-stepping lower as of right now. And there's still work to be done. So my thoughts are this. Here's a level. I posted this chart along with NQ. We're looking right now at ES. That's the S&P 500 E-mini futures. They're right up here in the top hand corner. If I don't make mention, you'll see what symbol I'm talking about, as well as the time frame. In this case, it's an hourly chart or 60-minute candles. So here's what I'm looking at. The most significant level on here, I highlighted or made the level blue. It's at 288, 2882.75-ish resistance level. And what stands out to me is that was a major divergent high, reaction high right there, followed by a correction. We came up, failed it again, popped it but couldn't hold it, fell back down, and then finally broke out and made a successful back test. And we danced on it a little bit here. We back tested again, and then the back test failed. And so what I'm doing is just, kind of showing you what my eye sees that defines that as a resistance level. We came back up there, failed on the back test from below. Support once broken then becomes resistance, and so we fell back, and so we're back to it now. I did post these charts a couple hours ago on the home page under the last update I posted on that post in the comments section there. And so anytime you can subscribe to a homepage post to receive notifications if there's any new activity posted under the comments section. All right, so that's it. Where we're at now, I expect a reaction here, but if we don't get one, I'll tell you that's going to be really chalked up as nothing but near-term bullish, just showing a strong demand. But again, I do favor reaction here. It's significant resistance, and it's not just because ES is here. I'm going to show you NQ in a second. But the levels to watch, you can see down here that you have a support level, price support, and an uptrend line forming as well. So a pullback there. I mean, if you're an active trader, that's certainly a lucrative day trading op on the ES. If you did a few contracts or even a single contract of ES, you can use the MES, the micro, and short at 2883, we'll call it, with a stop not too far above, swinging down to at least this target in this trend line. But break of that would trigger a more significant sell signal and probably take us down to any or all of these next levels down below. So we'll just see where we're at. Again, if we can power right on through here with very little or no reaction, then I can't really spin that as anything but near-term bullish. I'd say there's a pretty strong bid in the market right now, more buyers and sellers, and I may even let that SPY short trade go. Last week, suspended the stops. I'll get to that in a second. And it started working out, but we're back to or just above that suggested stop level, and it's based on the daily close. We'll get to SPY in a second. Before I do, let's look at NQ. NASDAQ 100 E-minis are also at significant resistance, and that's why I expect a reaction. This is the same chart I posted earlier, except it's updated now. We really have gone nowhere from there. So far, we've stalled out around that level. I could add just like on ES, I can add a little minor trend line here, which I think I did on that chart. So you have this little wedge, and again, you have dual resistance levels. I colored this level blue. It's 89.5650 right there. Again, it was a major high right here, reaction high and a divergent high, followed by probably the biggest correction that we've had since the markets put that major reaction low in March. That was a big drop there. Came back, tested it, failed. The NASDAQ 100 broke out, and it proved to be a false breakout, aka bull trap. We also had a little minor trend line break there, which was back tested as well. So what I'm showing you are all the reactions on that level, and we're back there now. So I would be surprised if the market just went on through here like it wasn't there. So at the very least, I expect minor pullback to check this downtrend line, and quite possibly more. And so we'll see how today shapes out, and I'll put a post out before the close on my thoughts on that SPY trade. And again, some of you may have already stopped out, some may not have taken it. Do what you want, but the bigger picture is this, and that's what we have to look at. If you're frustrated with trading, whether long or short, the bigger picture is we've been in now for a month, well over a month now, a big sloppy sideways trading range. The market had a big drop into the March lows and had a big nice sharp recovery rally, and we've been chopping around. So at least from this point on, bulls nor bears can declare victory because we've gone pretty much nowhere. It's a trading range, and it's a sloppy one at that. It's not well defined. You can see in that trading range that I just boxed in there, we had one false breakout to the downside and one false breakout to the upside. So, all right, take it for what it's worth. And again, that's a pretty important level right now. I think we're at. We power through it again. It's another breakout, and maybe it sticks this time, or who knows? Maybe we get another failure. So let me just put that line back there. These are the levels that I'm watching today. And right now, yeah, I can say this, that if I didn't already have a short position on the official SPY short trader personally, I wouldn't be shorting here. You could, it's objective because it is resistance, but I'm not liking the way the market's behaving following these sell signals. This snapback rally, although it's not uber impressive, there is just a ton of liquidity injected in the markets, and I would prefer to see a little more convincing action to the downside. I want to see first and foremost a rejection here. So again, you can add, it is objective as I mentioned, especially for active traders or even a swing trader, with stops not too far above, because those are pretty important resistance levels that if taken out, it should likely open the door to move to run at and test and maybe even take out those previous highs. But as of now, I'm still leaning towards this resolution right here, a downside break, a rejection. Like I said, at minimum, at least a small pullback, and quite possibly more, especially if that trend line's taken out. So that is my preferred scenario right there. We're just, like I said, we have to overcome the amount of massive liquidity. I was just reading, I think it was yesterday, the Journal put out a article that the U.S. Treasury is expected to borrow $3 trillion in the second quarter. That is 5 times more than it borrowed at the height of the 2008 financial crisis. Crazy, insane numbers. Trillion is a lot of dollars. And they also expect to issue $3.7 trillion in net marketable debt in the second half of the fiscal year that ends September 30th, bringing the total estimated debt issuance to nearly $4.5 trillion in fiscal 2020, which dwarfs the $1.28 trillion billion, I don't know, there must be a typo there, I'm reading off that headline, that the government borrowed last year. So crazy numbers, a lot of liquidity injected in the market, against a cross current of the sharpest turn that we've ever seen in economic indicators, unemployment, GDP, everything falling off a cliff. So I still, like I said, I'm a firm believer the fundamentals will play out over time. And again, the technicals are there as well. So the case right now can be made, there it is, that we probably have seen the highs for the day right here. And that's what I favor. If not, then something else is going on, and that's why I'll make that decision today. If they happen to power on through here, I may just let that SPY trade be taken out on the stop. Here it is right here. There's our suggested stop, is based on a daily close of 286.08. We suspended it last week for a few days there, which was a good thing. We got back below that level, but now we're back above it now. So at least we'll see where we go today. And again, the bigger picture, if you take a step back, yes, you can say this is resilient, and that's why we had a breakdown here, and this could just be the first kickback wave. But ideally, I want to see us turn down and go on and take out those lows. That's what we need to do on SPY. So there's the suggested stop. There's the recent price action. You can see what's going on there. And I have another board that I've been sharing as well, which I can find for you right here. The key levels, these were posted yesterday. I moved this line down to 278.42. There's quite a bit of reactions there, and that's, of course, most importantly, the most recent reaction low from yesterday. You had all kinds of levels there defining that, a big old gap, gap 2, gap 3. It's gap city through there, and that's why you have a lot of reactions on there. And of course, on the upside, you have a gap right here as well. And see this gap? And we're at the top of that gap now. So there is resistance that we're at on SPY as well as ES and NQ that I just showed you. Need to see this PPO trend indicator. I usually use a cross of the 9 EMA, that's the white line, the last of the two to cross, down below the 0 line. But in this case, I'm adaptive. I'll look and see. Lately, we've had a couple brief whips down below, and so this purple line really seems to be defining the uptrend right now in the PPO. So again, it all points to this. This is what I'd like to see to keep the bearish case, in the case for some of these short trades, alive and healthy. Would be a reversal here. So this is just nothing more than a minor kickback rally after the breakdown that we had last week. And then we go on and hit these targets. PPO flip down into bearish territory like it did here, telling us we're in a downtrend, and like we did here. We had one little, in fact, this was just a brief whipsaw to the upside. And to be honest with you, it wasn't even a whipsaw, because back then, as I said, and I usually do, I use the 0 line as the delineation point for the trends. Bullish when the 9 EMA is above, bearish when below. And you can see back then we had a perfect back test at the 0 line. It kept the trend bearish from this signal. So that was a clean sell signal, at least on this trend indicator from that point right here all the way to across back here, said bearish, stay short, the trend is bearish. And so here, that's where we went bullish. And again, I'm modified that line to about 0.57, because that's where we seem to be catching and turning back up so far. So those are the things I'm looking for. Keep the bearish scenario alive, and move up here and keeping this trend intact. Look, you're still going to have the divergence. So I want to say that we could just go up and make a marginal new high. That's pretty darn common when you have a rising wedge or breakdown like this. So you come on, you have a kickback rally, maybe you back test the trend line, maybe not. But the thing is, I don't want to see a back test on that SPY short trade. Why? Because a back test can come here, it could come here, it can come here, or you may just keep going. So that's why I'm going to keep relatively tight reins on this one and make a decision later today on the, as far as stops go. QQQ, there's QQQ, there's that potential head and shoulders. It's getting a little stretched. Okay, number one, the Qs took out the top of the gap. I can't spin that as anything but bullish near term. There's the gap I'm talking about right here, this gap. We gapped up. It was also resistance from a reaction there. So a couple things happened. We took out the top of the gap, which again, I can only chalk that up to being near-term bullish for now. It was resistance. It's also taken away the symmetry. Remember, these question marks, I said all along, this is only a potential head and shoulders pattern. It would have been and could be confirmed if we reverse soon. But once you take out the head, then your right shoulder is too big. There's no more symmetry. And the head's just up here. We're almost to the head now. So even at this point, you don't have the ideal symmetry. So again, potential will soon begin to dissipate, and it was never a confirmed head and shoulders. It only would have been had we reversed, kept some rough symmetry on the pattern, and made a impulsive move back down to the neckline there. So like I said, this is doesn't help the near-term bearish case, and another reason I may just let that SPY trade go today. All right, now let's talk about a few other trades. Let's just go through the active trades on the site. Again, my thoughts on what I said about shorting the indexes would also mesh with the other trades. In other words, there's still active trades. A lot of these, there's not enough in the charts, not even close, for me to modify that, to pull this trade early. I'm just going through these one at a time. SOX is an official short trade. From a technical perspective, it looks great. Like I said, I'm not crazy about the resiliency, the price action, the broad market right now for all those things I just went over today. Again, they're not nailing the coffins for the bearish case, but it's just not ideal. Again, there's just a lot of liquidity injected into this market that's and a lot of price distortion. I talked about that before. There's, what the term price discovery in the financial markets has been erased, and that's a dangerous situation. Warren Buffett even alluded to that in his annual meeting recently with Berkshire about the what the Fed's done to backstop the corporate debt market. That's a dangerous game, and when you're doing that, a lot of experienced traders and professional investors, they look at the credit markets actually for cues on the stock market, for red flags when you see credit spreads widening and things like that. And there's a complete and utter, unprecedented, never anything like it in history, distortion, even way more than back in 2008 of the credit markets with what the Fed has done here. And again, so what they've done is they've removed one of the probably the most critical component of the financial markets, and that's price discovery, which is the natural interaction of natural buyers and sellers to determine the price of a security. So we got to be careful here, and but I'm going to stick to the charts. And I just want to say SOX looks fine. With divergent high, we had a impulsive breakdown, kickback rally right to resistance. I haven't modified this chart. Here's the level I've had here since this trade before it was even entered, I believe, 231.64. It's resistance. You can see we've went right up to there. Looks like a little flag pattern, bullish pennant or a flag could be, and if so, if it breaks to the upside, the measured target, if you don't see what I'm seeing, let me just point it out. This would be potential flagpole and impulsive move up, leading to a pennant type formation, and the measured target would be the distance of the flagpole added to the pennant or flag if it breaks out, and that would take us to a back test, which is going to come darn close to or could come up to or even above our suggested stop, which is a daily close above 240.70. As of now, again, there's not even remotely enough in this chart, even with the recent price action of the market, to make me second guess this trade. So I still like it. We'll stick with it. If I decide to modify the stop, somebody asked why I set the stop just below the previous reaction. I already answered that under, I believe, under this trade idea in the comments section on the homepage. But again, we'll see. I'm a flexible, adaptive trader. I'll see if we need to make any modifications to this trade, meaning either close it out early before the stop is hit, or modify the stop, or suspend it, or anything like that. But as of now, still looks fine from a technical perspective. Would certainly help to see, a little more bearish evidence of, reversal at these resistance levels I just showed you out on the futures, breaks of those minor trend lines on the futures I started out with in the video. That would certainly help the case here. And of course, sometimes you can see the market continue to rise in a certain sector, even though a lot of these, most or all of these stocks are big components in the NASDAQ 100 or composite, as well as the S&P 500. There are times where you can see a sector like the semis do their own thing. In other words, move against the grain in the markets if the market's going up. So again, we'll base this trade, or hold on to it right now based on its own merits, which still look good. But we definitely want to see this. And like everything else, you want to see a break of the recent reaction lows to open the door for the next leg down. Like I said, looks fine. Next one up, NVIDIA. NVIDIA is an overlapping trade. You need to be aware of that. If you're, short the NVIDIA official trade and you're short SOX or one of those various inverse semiconductor ETFs, then you have overlap because NVIDIA is a component in most of the semiconductor ETFs. So it still looks fine. We're not far from our stop. It kind of meshes with what I'm seeing in the market. If the market can power up much more from where we're at right now, it's going to be near-term bullish, and so for the time being, I'm just going to sit tight on all these, trade parameters. Beautiful looking chart, breakdown, but again, it's being held up with the strong bid in the market right now. It's needs to take out, like everything else, those recent reaction lows. SPY I already covered. DPZ, that's Domino's. We were just looking at 60-minute charts a minute ago. Domino's is based on a daily chart. And we already hit our first targets. We had a quick profit. It dropped down. You remember the charts I posted, the original one I showed it, playing out like this. So again, this bounce in the market is not unexpected. In fact, it was expected. If you recall on the initial post on this trade, I was hitting that target, bouncing. Domino's is I believe, a component of the S&P 500 or Nasdaq, or maybe both, I believe. If not, it's going to be at least be in the mid cap index, and it's going to trade in line with the market, and that's exactly what I had it doing. Going to hit that first target. The arrow showed a bounce up to about that level. So far, we bounced off that level up to there, and soon start another leg down that again would mesh with what my expectations for the broad markets are. And if we do much more than that, then so be it. And at this point, we already hit the first target, and maybe some of you already took profits there, reversed it to along to game that bounce. Maybe not. If you're still holding out for these other targets, you could certainly lower your own stop down to at least entry or lower to at least assure a break even or a small profit on the trade. Or if you're swinging for these targets, you need to give this thing room, and that's why the stop, I'll leave it as is for now. Costco, not much more to report on that. This Costco is a very long-term, like Berkshire, based off the long-term charts, and we're right about where we started on this one. It's been moving around here, consolidating. The fact it's not going up with the market is good. I think I made what I believe to be a pretty good fundamental case for a short on this, and a technical case. But I said it gets much, much better if we can take out that trend line and that first target support area around 282. That would open the door there. Verizon, also based on a weekly chart, and giving it plenty of room, and so far it's playing out. So there's really not much to say. We came up, we shorted it somewhere here. On the back test, we have a downtrend line as well as this uptrend line. So from a technical perspective, I think it still looks great. Big negative divergence, just like we had back here before. That was followed by a 25% drop. And same thing there, a breakdown and a back test. Here we had a back test a little quicker, and then the stock dropped. Here we had such a sharp drop, and we're back testing from below, and I think we get another leg down. So for now, it looks good. Again, it's not going to pay out or play out down to those targets until and unless the market reverses, because this is again a big component of the indexes. So the fact it's not going up with them is promising. That showed that what we call that underperformance. Even if it were to move up a little bit, if the stock market, the S&P 500 goes up, let's say 10%, and Verizon only goes up 5%, you call that underperformance. Yeah, it's still going up, but it's lagging behind, and so you're looking for these weak stocks, and they're most likely to lead the way down if and when we get a reversal in the market soon. Berkshire, also a very long-term one based on the weekly charts. Like I said, they just had their annual meeting and all that stuff. They didn't do it in person this year, of course. It was all virtual. So that's it. We shorted it at 195.90. Way up here. We're profitable on the trade, by a good margin right now. But I was, swinging for the fences on this one. It's a longer-term trade. Maybe not swinging for the fences, but I had longer-term swing targets. It still looks good. So we're profitable. The charts look great. It reversed where it should have. We shorted it on the kickback to that resistance right around here. And like I said, not much else to add to it. LQD, talked about this one quite a bit. That one did, I think in hindsight now we can say did a good job for suspending the stop there on a daily close above 131.35. By doing that, instead of being stopped out here at about 132, so far we've gained back, almost half of that gap now. That's about 2.75%. Actually, down to the lows yesterday or the day before, it was about a 3%, recovery, if you will, from losses. So we had two very, quick and profitable trades on this earlier when on the way down on LQD, and this one we got caught in right before the announcement that the Fed was going to come in, and they evoked emergency charters that were only used back in the Great Depression in 2008 that allow them to come in and buy ETFs, even corporate bonds and LQD, to backstop the corporate bond market, so and junk bond market for that matter. So that's it. I did say that once we entered the gap from above, we'd probably backfill it like we did on JNK and LQD, the junk bond ETFs, and that's still what I'm looking at there. So like I said, this one, and I've already shared my thoughts. And had we, had the Fed not come in and done that, I wouldn't. I wouldn't short it now. I'm just leaving it on, and I may close that one out early on a gap backfill or something else, only because the Fed's backstopping the market. So the chance of us getting down to T2, it's still a possibility. I think they're not going to let the corporate bond market crater, or at least they're going to do their darndest not to. Whether they're successful or not, only time will tell. But I don't think they're going to keep them. I'll bet you they don't like the corporate bond market up near new all-time highs right there. It is gross distortion of, again, price discovery. That's not where these, you have the economy and the market's fallen off a cliff. And yes, they're trying to backstop as many companies as they can, but I promise you, the Fed cannot save the world. They cannot save every single corporation out there. So this is dangerous. Taxpayers are going to be, the bag holders on massive, massive losses as we see, tons of bankruptcies coming down the pike in coming years. They're just extending. It's a stay of execution is what they did give to a lot of companies that were already on the verge. And I might sound callous, but it's a natural. I think of the financial markets just like the natural world. Where the sick and the weak are killed by predators or die from disease and move on. And that's the same thing in business. Businesses that are sick and unhealthy. In recent years, and at the top of a booming, go back a few months, economy was booming. Any company that was junk rated or being downgraded. They need to go in a strong economy. In a recession, again, it's just you're keeping a patient alive on life support when they're brain dead. That's what the Fed is doing here. And again, there's going to be massive losses, and again, taxpayers will eat that. But they're not going to. What I'm getting at, they can't keep it up here forever. They just don't want it. Credit markets, as I warned about back here, would have broken and started to break had we gone much lower on LQD, corporate bonds, and other things like that. And so, I think there's a possibility we can get down here. They're just going to fight to keep it, much below those recent lows right there. GLD, not much to add. Same old, same old. I've been updating the last couple of weeks. Updated quite a bit. We're kind of holding up, which I view as bullish. As I've been saying for a while now, I'm cautiously bullish. There are a lot of negative divergences on the all the way here, the 60-minute chart, daily chart, all the way out to the weekly chart. We recently had some divergences, but again, that's against a backdrop of a strong, good, a bull market. Gold being in a bull market. And as I said, usually it's not unusual to see negative divergences in a bull market play out for correction more so in time than in price. And that's so far what happened after this last divergent higher here. We've consolidated more so in time than in price. A little bit of a give back in price. We're not out of the woods yet. So again, what I said a week ago, maybe 2 weeks ago, if I didn't already own gold as a long-term position, I wouldn't be adding here. I would hold off and either wait for some upside breakouts and get rid of those divergences, burn through those, or maybe a pullback to a support level. And there's still, I think, still a strong fundamental backdrop for gold too, because the financial markets are not out of the woods. It's still, by all metrics, from the longer-term charts, nothing more than a bear market rally. Whether that proves to be the case, 6 months, a year from now, when we look back in hindsight, who knows? But as of now, as I've gone over quite a bit lately on the long-term charts, where the percent retracements, resistance levels overhead, things like that. We can't say that it's anything more than just a bear market rally at this point. And then finally, as far as active trades go, Palladium, I already posted an update today. We hit that second target yesterday. And still looks good. This was made what I believe to be a very strong fundamental and technical case. Auto sales, plunging, falling off a cliff. Auto production plunging off. Who's buying the palladium? If Ford's not building cars, who's buying palladium for the emissions controls? And again, I'm speaking metaphorically. I'm sure some of the automakers have already come back online or will come back online soon, but do you think they're going to be selling as many cars as they were back here at the peak? No, not with unemployment going through the roof in in the world's largest economy here in the U.S. So and again, not much better in Canada, Europe, most Asian countries. So anyways, that's again the fundamental case, and I've covered a lot of analysis, long-term analysis on palladium futures and this ETF, and showed you, the corrections in the past after we've had cyclical bull market peaks. The corrections and bear markets that follow are usually about 70% or so. So as much as we've already dropped off the highs in palladium from that initial low, it was about a 50% drop. I think there's a lot more to come in the coming months here. So that's still third target and the final target for now, and may be extended, or who knows, if I see something that I don't like on the trade and I want to close it out early and book profits, I might do that as well. I did lower the stop today, by the way. You might want to put a little bit lower stop, but I lowered the official stop down to 201.82. And that's it for the official trades, and a couple more I have to share with you that I'm liking recently. This one I actually started, I marked up a chart on wheat yesterday. I was going to post it as an official trade idea, and I probably still will. Here you can see my targets. Wheat, we've traded on and off over the last few years, mostly as longs. We had a official long trade here, hit our targets right there, T123, again T1234. Hit the targets, and at the time I said we'd use the same targets as the previous trade back here. We've been buying it off these divergent lows at the bottom. Now, so both times I mentioned it here off the lows as a swing trade idea, and this time around I don't think we're going to get there. What I'm seeing is wheat is making a series of higher lows so far. Each low a little bit higher than the other one. Bigger picture, it's in a multi-year trading range, basing pattern, whatever you want to call it, which I think is very powerful, and I do expect ultimately an upside break out of this range. The global central banks have just flooded the system with liquidity. That liquidity is going to find a home. It's finding a home in risk-on assets right now because that's where the momentum is, meaning the stock market. And when that tide changes in the stock market, that money is going to find a home somewhere, and I'm thinking a lot of these commodities will be beneficiaries of that. With that being said, it is at support, that 528 level, going all the way back here was first target that back last time around, second to last time around back in early 2019. It was again the first target back here, and it's just a level that's continued to show me that traders step in around that level. Now I put a higher weighting on wheat futures, which we're going to get to in a second. So again, you can see the targets. May add this as an official trade today or tomorrow. I'm going to have to step out of the office here in just about another 10 minutes. As soon as I wrap this video up, I'll get it out to you guys. But I wanted you to see those targets. Let me show you the basis for the trade. It is largely based on what I'm seeing on ZW wheat futures. Okay, this is ZW 60-minute chart of wheat futures, and what I have here is nice bullish divergence that's been built just like back here. What I believe I mentioned at the time, it's watch, rinse, repeat stuff. It's nothing's guaranteed 100%. I don't want to make it seem overly simplistic, but it kind of is. In other words, I don't guarantee that these divergent lows will play out for a trend reversal, but they have in the past. You look for the divergent lows, and you're usually followed by nice rallies. Same thing here. Positive divergence has been building. It's even getting a little steeper. In other words, the divergences are getting larger, and also you can see this increase in the slope on the indicators right here as price bottomed out right at that 505.804 support level. And here was our, we had a downtrend line. We recently had a breakout, and this is the level I'm watching. And so I think we'll get it, but the most objective buy signal is going to come on a pop above that 523.74 resistance level. We've been checked there several times recently since the breakout. That's building energy. So if we can pop it, I think wheat will do something along these lines, reaction there and run up there and possibly more. So there's the case. We already had a buy signal in the breakout, but we have resistance here, so it needs a little more upside. And again, I just want to do these videos in case I don't get that trade out as an official trade idea. Like I said, I have to step away from my desk for about an hour today, maybe a little bit more. I can get out to you, great. If I see the breakout, if not, you can keep an eye on this. If you don't have a futures account, Ameritrade gives you free futures quotes. You can get ZW, so put a / sign in front of the ZW. Investing.com gives you free real-time futures charts and quotes and all that, so you don't even have to have a futures account to track wheat futures. Another one I like is coffee. Same thing. Coffee, traded on and off, long and short over the years. And here's KC Coffee Futures. Oh, by the way, I already showed you wheat. The ETN was WEAT. Just drop the H for the ETN, for you ETN traders. And then here's coffee. Same old simple stuff. Wash, rinse, repeat. I always say divergences are not a buy signal. They are an indication of a reversal, whether it's positive divergence, which is bullish, or negative divergence. What your buy signals are, or objective long entries, I should say, are a pullback to support, in this case trendline support. You can see boom, boom, boom. We're making a series of lower highs here. Wouldn't call it an uptrend yet. It's more of a grind, but it is a series of higher highs we just need to take out. It will be a confirmed uptrend when this previous reaction high gets taken out, because then you'll have a series of higher highs, and next one being up here or up there somewhere, and higher lows as I showed you down here. And that's simple watch, rinse, repeat stuff. So positive divergence and a pullback to support is an objective long entry. On top of that, you just broke out, actually, since I started the video earlier today, I was put this down to cover it and show you guys a break above 108.99, or call that 180, 190, 108, 109 rounded up in coffee. That was those recent reaction highs there. So this should open the door for a move up there, followed by a reaction, then a move up here. You can see my targets for coffee futures. And for those of you that don't trade futures, JO is the ETN. Again, been traded many times over the years. And usually I look for, just like wheat, this is reminding me a lot of wheat, even though it's not even related. I mean, other than being an agricultural commodity, but grown in different climates, but the same story. We had two lows, and we went long both times back there as well. Those were positive divergent lows. And this one again, so this one actually had a triple bottom. Every time JO has come down to that 3068 level, it's a gift. It's easy. You have positive divergence at support, and I believe I mentioned it here recently, and it runs up. Now, you might say, oh, well, Randy, why don't I just wait for that? Well, sure, if it gets there, great, but I don't think it's going to this time around. I suspect that third time's a charm. We probably won't see that level again, and this may be the last chance to get on board before the next leg up, and maybe a move that comes up here and challenges those previous highs. So that's one I like as well. I'll have to mark the chart up. These are old support and resistance levels. Disregard these. This one's valid, about 34.80. So really the same story. Well, no, actually coffee futures just broke out. It would help to see Joe take out 34.80 because that's minor. There's a little gap there. But again, I put a higher weighting on coffee futures than I do these ETNs. They do a good job. Wheat and Joe do a good job of tracking those respective commodities. And again, if you don't trade futures, it's your only other pure play option. There's no other way to, profit from rises in coffee or wheat or anything like that. You either trade the futures or the ETNs that track them. And again, these guys are not leveraged up. They are ETNs. There's always risk with, anything like that, but they're not leveraged like some of the, ETNs and ETFs out there. So you don't have the degree of risk that you have in those other ones. And then finally, I mentioned KHC recently, and the earnings are out of the way now, so we have a green light. A couple, I mentioned quite a few unofficial trade ideas, including that, Beyond Meat, which I, put a little update on the homepage today. That one was highlighted in a trade idea right here, short at the 20 EMA and the downtrend line on April 24th. And it was good for about a 22% drop. But as I warned at the time, and since then, May 5th, tonight, they report after the market closes. So no reason, that one you should have booked profits, at this point. It is back testing that line. I don't have much of an opinion now. And again, this one's a volatile. It's a relatively new company. You're rolling the dice. It's a pure gamble to go long or short into earnings on this one. But KHC, the point is, I like these stocks. Once earnings are out of the way, then you don't have that to worry about, a big gap against your position due to a earnings beat or miss. And KHC is out of the way. Not a screamer. They've been in their own bear market. They've had their own problems fundamentally, but how much of that's been priced in over the last couple of years, with the stock getting whacked. And again, strong chart on the weekly and daily. I already highlighted positive divergence. It broke out here and back tested the primary downtrend line and had a little run up. It's coming in for a near back test. But what I like about it, you zoom in, you can see, you probably can make out, hopefully in the video, if not, make sure you're check that little settings wheel and make sure it's playing in 720p. That's what I recorded in, and it should be clear enough unless your monitor is not clear. But there are a confluence of moving averages. They're up here. I have the 50-day exponential moving average, the 200-day in red exponential moving average, and the 200-day simple moving average, and they're all converging right about here. They're pinching. So before it was resistance, now you're seeing KHC taking all those out as well as the trend line. So again, the point is you have a confluence of support now just below. Okay, let's wrap it up here. Back to where I started, and we'll wrap it up. Just, indexes are still at those resistance levels. And again, I favor reversal here. Anything much more than that, then I'll post an update before the close and let you know what I think regarding the SPY trade. But that's the only one, as I said, that's in jeopardy being stopped out right now. And even it still looks good, but the others look even better, so I'm leaving those alone. We'll wrap it up here, get it out to you guys, and I'll follow up with some either static charts or a video before the close. This has been Randy Finney with Right Side of the Chart. Hope you enjoyed it.